Good morning, ladies and gentlemen. I'm Mattia Romani. I'm with Holistic Investment Partners. Thank you so much for making the first session of the conference today. We have a very special panel with us. We will really discuss about how do we scale up climate finance to reach the trillions that we know are required to accelerate the transition to a low-carbon, nature-positive economy. And who's better to start it off than Hubert Keller, the Senior Management Partner of Lombard Odier. So may I ask Hubert to come to the lantern to give the keynote speech. Thank you, Hubert.
Thank you, Mattia. Ladies and gentlemen, good morning. It's a real pleasure to introduce this panel. Again, I think we all know the transition to a net zero, nature positive, and socially just economy is going to be one of the most important economic transformations of all time. I think it's also important to know, just to structure the discussion a little bit, that it has several chapters. It has three very important ones. The first one is around energy. We need to effectively electrify most of our energy systems between now and 2050. The second chapter is around nature. Effectively, we need to return about 20% of our agricultural land globally back to nature between now and 2030, and this will obviously have a profound impact on our food systems. And the third chapter is around materials, where we need to reduce the materials intensity of our economy by about a third, if not more, again, between now and 2030. So in front of these huge economic challenge, there are really sort of two key questions that we need to ask ourselves today. Is capital flowing at scale in the right places? And if not, what should we do to unlock it? Now, the good news is that when we focus on OECD countries and the transformation of our energy systems, we do see, in fact, capital flowing at scale and, in fact, unlocking a new investment cycle. But the bad news is that we don't see it yet flowing to the same level at all, both in nature, in potentially materials, and particularly in Global South. And Global South is also particularly important because this is where the majority of highly important nature assets sit. Now, I think what is always important to bear in mind is when we think about public sector capital, what are we really talking about? And public sector capital comes mostly in the form of corporate investments, i.e. CapEx. And CapEx are deployed when there is a strong economic case. And so therefore the key question is, how do we develop these strong economic arguments for corporate CapEx or corporate investments to start to flow at scale? And when we look at every single economic transformation throughout history, we reach tipping points. So where these new solutions become economically attractive and viable, when we normally reach or get to about three important criteria. First, the new solutions need to meet the test of affordability. Secondly, it needs to be a more efficient solution than the existing one. And thirdly, it needs to be able to scale. Now, of course, governments and public policy have a role to play, but primarily to basically de-risk that innovation cycle in these new technologies and also support the deployment at scale or the mass adoption through smart subsidies. And this is, by the way, exactly what we are seeing right now in OECD countries with the EU Green Deal and with the IRA. So when we look at these questions of what are the economic cases, the really good news is that when we look at the overall environment transition, we find that we actually have 90% of the technology or the solutions to be able to execute. And the other really good news is that most of these solutions, the green solutions, are within 2 to 3 years of that famous tipping point where the economic argument becomes sufficiently strong to attract massive amount of corporate investment or capex. And we are witnessing that already in Global North with the building blocks of electrification, which have already, in the last 2 to 3 years, crossed these famous tipping points and are moving towards mass adoption. And just to share with you some important figures and comments on the topic, in 2021, we saw about $1 trillion of capex being deployed in the transformation or in the electrification of our energy systems. This is as much, if not more, than the amount spent in the total fossil fuel industry. We're seeing mobility, buildings, industrial processes being electrified at a speed and scale today in OECD countries which is often underestimated. And so this new electricity demand obviously requires massive amount of new electricity infrastructure. And again, the good news here is that solar, wind combined with battery has become the cheapest source of electricity in the planet. So much so that 90%, and I really insist on this point, 90% of all new electricity infrastructure in the world, on the planet, are deployed through solar and wind. And we will say that we see between 3 to 3.5 trillion of annual capex being deployed between now and 2030 into the acceleration of electrification. So I will finish my introduction by basically saying again, we see today capital flowing at scale in the energy systems, in OECD countries, and we can actually see a new investment cycle starting because the economics have become simply irresistible and are attracting this huge amount of capex that I've talked about. So the key question for this panel, before I hand over, is how do we develop similar economic arguments for Global South and for nature in particular? Thank you very much.
Well, thank you very much, Hubert. As an economist, I like the idea of economics being attractive. So I really second that. And I mean, it's good to start the morning with some good news. And I think Hubert did share some good news about the flows of money that are going, particularly into electrification, the Global North. We have a tremendous panel. I'm not going to introduce them one by one. You have their biographies. I'll turn to them to try to answer the question that Hubert has posed. And let me start with Barbara Buchner from CPI. Barbara, we heard Hubert talk about some of the flows. CPI is probably the world leading institution, actually it is the world leading institution of taking stock of financial flows to the transition. So tell us a little bit about how money is moving around the world on green.
Absolutely. Thank you so much for having me here. Big thanks to the organizers for having me part of this exciting discussion here. And yes, I think I do want to start with some good news and echoing what Hubert said. We have seen climate finance actually increasing over the last decade. At CPI, we have been tracking and assessing global climate finance flows, both public, private, domestic, and international, since over a decade. And we have seen climate finance flows in these last 10 years, actually almost doubling to about $4.8 trillion cumulatively. And so the last report that we published last year, which was looking at the 2019-2020 figures, showed a kind of an average global financial flow of about $650 billion in terms of climate finance. Spoiler alert, we are going to release our newest report in a few weeks later this month. And we will be seeing, actually, for the first time, that global climate finance is exceeding the $1 trillion number, which is great news. And I can't give you all the details yet, but stay tuned for what will come. Maybe just some of the highlights, what is behind these numbers. And I think, again, also echoing some what Hubert said before, I think positive part is we have seen both public and private finance increasing. Again, it's been about a 7% average global growth rate that we have seen in terms of climate finance. However, we have seen public finance increasing faster than private finance. And again, I'm looking at global flows, so not only at OECD countries, but global flows. And you have seen that private sector has been increasing, but at a growth rate that was only a little bit over 4% compared to over 9% from public financial flows. So I think there is certainly something we need to do in order to make sure that we get the incentives right and we really manage to price the risks right as well. So I think that's the first part. Second part, we have seen a concentration of flows still in developed countries. So 75% of global climate finance flows currently are concentrated in Northern America, Western Europe, and East Asia Pacific. And I think that is, again, to the same point, we need to make sure that the money is actually flowing where it's needed most. And where it's needed most is, I think, brings me to the final 2 points that I want to make. First, we have seen most of the global financial flows going towards mitigation, towards renewable energy, towards transport, while financial investments, let's say, into adaptation, into resilience, are still lagging. They have been increasing more over the last few years, which is good news, but they started from a much lower base, so we're still kind of far falling behind of also the goals that have been set on international agendas, and I'm sure we're going to talk about that one as well. Final point, because I do think it is actually bridging to also what is needed, is more than 75% of global finance flows are raised and spent domestically, and that really shows the importance of strengthening domestic capital markets and integrating and working with national domestic financial institutions, both public and private, to really make sure that we are creating the right enabling environment and the right partners in countries to really raise more money. And so again, I think that's just giving you a quick overview. I think maybe ending just on what I think is one of the key barriers and key causes of why we don't have more investments flowing towards developing countries, and that certainly is the high cost of capital that we see in developing and emerging economies, and that I think is a really important entry point to think about the solutions. So let me stop here.
Okay, thank you very much, Barbara. Very quick overview of very important topics. $1 trillion, first time ever of climate finance. You heard it at Building Bridges First. Just another very important point you make is the point about cost of capital. Avi, let me turn to you. Avinash Parsaud, Senior Advisor to Prime Minister of Barbados, Professor of Economics, but also one of the key people, in fact, the key person behind the Bridgetown Initiative, which has been really a very important force for good in thinking about how to increase financial flows to developing and emerging countries. We have from Hubert that the Global North is gearing up. The engine is revving, or your EV is charging up, and it's going faster. Is the transition in the Global North compatible with the transition in Global South? Is there a natural link between the two, like Hubert indicated? Private finance goes to finance corporates that may well invest then in the Global South. What is the link? Can we build on each other?
Great question. And Hubert, I think, set us the right challenge, and I largely agree with his diagnosis with a few caveats. But let me first thank you and the organizers and Patrick for bringing us all together in this important event. I think, firstly, to say, as an economist, that it's the right industrial strategy for Europe. It's the right strategy socially, environmentally, and economically that Europe is a leader in this green transformation. And Europe can get there and has been getting there through good policy. Policy has driven this. In my first part of my career, when I was an unreconstructed banker, I used to visit Frankfurt a lot. And if you had told me that Germany would be the world's leader in solar power, I would have said, where's the sun? But it didn't, policy trumped the lack of sun for Germany. Germany began as the leader in solar power, and that was all about policy. So policy can drive this. And it is also right that the emerging world, the global south, should adopt green transformation as a critical part of their social, environmental, and economic transformation. It's going to be a key growth driver, a key driver for development. And climate and development have very strong mutuality and duality to get there. But the development context is very different. And there is a certain arrogance, I will say, to my European friends, where they say, well, we did it this way, and so, because it's not happening with you, because you're not following our wise counsel on our policies and the way we did it. And the development context is totally different. And Barbara hit the nail on the head when she talked about the cost of capital. So she and Irina and IEA have done this analysis where you take the exact same solar project with the exact same technology, and the cost of capital in Europe will be about 3 or 4%, and it's about 14–15% in the emerging world, 20% in a lot of Africa, and even higher in other countries. So these projects won't happen. And when you tell that to financiers, they say, well, maybe it's because you got the wrong policies, the wrong sector regime, and we can work with you on improving this. And you know what? It's not that. I have been the lead negotiator for my little country with investors, and we give investors every single guarantee they want. We give investors more guarantees than I want to give them. We, unlike any European country, have to agree that investors can take me to court in a US court and a London court if they feel unhappy with the outcome. We have to agree 25 years of fixed taxes, no matter which government gets elected, what change of policy, and if we change policy, we've got to compensate them in a New York court. They get every guarantee, and they still don't come. Why? Because there's some genuine risks and macro risks that can't be addressed at the policy level. So the first thing to say is we're asking the developing world, and it's critical to preserve the planet, so it's a big ask, but it's an important ask, to green transform at a pace and scale that's never been done before by rich countries or anybody else. And so that means investment will exceed savings. That's why you have a big role to play. Investment will exceed savings, and that's why we need that means by definition an international flow of investment. And when you've got international investment going, you've got the first big difference with Europe and the global south. Firstly, your risk managers are living thousands of miles away from where they're investing, and distance creates a risk aversion. The second thing is you're dealing in markets that today do not generate your revenue, so you're not investing hugely in understanding those markets. Our credit rating agencies, we don't get a lot of people spending time. They're not going to make their career on rating my island. So they'd much rather rate big islands, big places, big countries. So we don't have a lot of good information. And the third most important thing that most of my European friends won't appreciate is the global international financial system is set up in a way that is particularly difficult for developing countries. We have an international financial system, and this will be my final point, has a group of countries who can issue safe assets. And that's not because the assets are actually any safe. It's because our accountants, our collateral requirements, our legal requirements, our international regulatory requirements say that their assets are safe and they're collateral for finance. And that means that in a global financial crisis, these rich countries who issue the safe asset, Europe, the US, suddenly they have a plethora of policy choices in a crisis. Their interest rates fall. Their currencies rise. They can start printing cash. Imagine you're a developing country. In a crisis, what happens? Your interest rates jack up. Your currency collapses. All your money's moving to the safe asset. So underlying, you've got risk aversion meets volatility. Cost of capital is huge. You're not going to solve that by tinkering around with policy risks and tinkering around with the project risk. We need ways, if we want to transform the world and preserve the planet, we need ways of managing this macro risk. We need ways of diversifying diversifying risk, guaranteeing risk, lowering this cost of capital. We only need to lower the cost of capital by 3 or 4 percentage points, and we could do that because it requires not a subsidy, and I don't believe in subsidies, because the amount we need to move $1 trillion per year into developing countries can never happen with a subsidy. So we need to do this by looking at these risk premiums and finding out where they're wrong. And we need the public sector to play the role of a risk-neutral player rather than a risk-averse player. They're not subsidizing, they're just taking a long-term view about where is the actual risk rather than the huge risk plus risk premiums. And that will allow us to save 4 or 5 percentage points in these risk premiums. And that will mainstream institutional investors, mainstream you guys and girls into these investments. And that's how we will transform the world and transform the South and preserve our planet. Thank you.
Thank you very much, Avi. I think it's interesting because it's a message almost to regulators as well in the global north and how to regulate financial sector in the global north, because a lot of what you're saying can be unlocked through that. It's a very interesting point. Let me turn to Mahmoud. Mahmoud Moyadin, UN high-level champion for COP27, also executive director at the IMF. I want to ask you a little bit about one of the things that you championed at COP27, which relates to what Avi is saying, although I'd like a comment on this point that Avi made as well, which was project preparation. You did a tremendous work at COP27 in gathering data sets of investable projects across regions in the global south to entice investors to come in and show them that this project actually make economic sense. Tell us a little bit why you did it and what was your experience with that.
Right. Thank you so much to be here again. It seems I didn't commit big mistakes last year, so I got invited again this year. And I hope not to do more of them, these mistakes. But I have to confront reality in some of the issues. We started us off, Hubert, by talking about the cases of the OECD countries. When you were talking, I thought it would be useful for the African countries perhaps to be members of the OECD, and then all problems will be solved. You'll have the subsidies that Avi doesn't like, especially if you are in the US. You'll have some protective measures for your business if you are in Europe, including CBAM, and some subsidies as well through the green initiatives. But even if you believe, unlike Avi, of subsidies in the global south, there are budget constraints. You cannot really mobilize funding for that. So the only way is to go in areas related to innovation, leveraging public finance, as Barbara mentioned, doing more at the regional scale and local scale. And this is what we try to do. We started by complaining and stating facts that funds for the global south are insufficient, inefficient, and unfair for reasons that I bored Barbara and Avi for many times, but they know these facts. Insufficient because we know that the 100 billion is only a fraction of what's required. We know it's inefficient because from the day that you shake hands with the financiers of the multilateral development banks and others, it takes you an average, in some cases, 18 to 24 months. There are some more efficient multilateral development banks, especially if you have pipelines of projects with them, that could be much shorter, 3 to 6 months. But if you are in a small island, that could be really the tough life that you need to face. It's unfair because of the cost of capital. It's unfair as well because of bias when it comes to mitigation. You may get some funding, and if it goes to adaptation, I call it the stepchild. If the child is mitigation, the stepchild is adaptation. And there is an orphan child that we are trying to protect, which is loss and damage. This is another discussion. So some sort of balanced approach will be very much required. So instead of just complaining, we said, well, let's do something better by answering a good question by GFANZ and the announcement of Glasgow that we have the money, the 130 trillion plus of assets under management. We have $8 trillion of asset owners committed. And then a good question, if the money is there, where are the pipeline of bankable projects? I said, well, it should be not just bankable, it should be investable projects because we have enough debt in the system. The system of finance for developing economies is too much dependent on debt, and not all debt are concessional. So we went into that difficult path on building pipeline of bankable projects. And about bridges, that was an impossible bridge to structure and to build. We had the public-private owners of ideas from governments and from private sector. We have the regional economic commissions of the UN, not normally acquainted with ideas coming from corporate sector or from investments. We had as well top fund managers, investment banks. We had a consultancy firm, BCG, and we had many young people active in building those pipelines. And this pipeline is now available for the 5 economic regions. You can Google that or check your best browser. It's called From Assets to Flows. And there is another one, a compendium of bankable and investable projects. But whether all of these projects, and I give you examples like batteries for motorbikes, from waste to energy, big project in Nigeria, solar plants in Namibia. I'm focusing more on Africa, given the discussion that we had from a few weeks ago in Nairobi. And it's great that we see many initiatives coming now from the Global South. Of course, the Bridgetown Initiative in its 2 versions, and it's good that Avi's here. But there are many other initiatives coming as well from Africa with practical solutions, not really asking for much because it seemed that the tough political economy dynamics and the geopolitics have been factored in the decisions. So it's all about having this kind of partnership that could push solutions. Very proud as well, not just of regional projects, but localized solutions as well. So those 2 levels have been always ignored. If you check the Paris Agreement, for the good reason, it's a global agreement, addressing capitals, heads of state, governments to do their best. But the regional dimension was not really emphasized, and now we see a great deal of opportunities in these regional cooperation dimensions. And the local impact is very much important to address for reasons. I'm using strictly my climate champion hat, not my IMF hat, but there is a piece on knowledge that I like to share with you that just came out, and it will be in Marrakesh in a few days. The facts are, in addition to all of these gaps on finance that Barbara mentioned, that banks, including the top 30 banks in the world, are not fully aligned with net zero targets yet. Second fact, that the share of investment funds, especially in the global south, is still small, and its impact is limited beyond the labeling of ESG. And this is something that we need really to unbundle and see what's really happening there. Third, that rating agencies are not factoring in adequately good behavior by countries or by companies if they are doing better in climate action investments and dealing better with the climate and environment. And fourth, that the regulators and supervisors are not really getting their act together when it comes to rules of engagement and monitoring what should really be happening. Meanwhile, you need to build these pipeline of investments and get some sort of good funding for. A good project, you reminded me of before this discussion, is Binban in Egypt. This is one of the biggest solar plants in the world, one of the top 4, competing with India and China, which had the top 3. Now, the expansion of this project had been very much reflecting good recommendation of a top economist, Esther Duflo, who said, you need to do better in poverty and climate. It's finance, that was mentioned, technology, Avi gave a hint to that, and incentive structure, which everybody talked about, including in the opening remarks by Uber. So Binban had all of that. Regulatory structure in terms of electricity prices in Egypt had been revised. Technology, you can easily talk about that, but the technology inventions happened in the US with innovation in Europe, in Germany and other countries, but production at scale happened in China. So these bridges between the US, Europe, and China benefiting Egypt that trained its labor, top engineers for maintenance and production of components. If any of these components are missing, the finance, the technology, and the incentive structure, we are not going to be having another big-scale solar project, not just in Egypt, but in other countries in the global south. And you have as well now the CBAM. We assume that is good for Europe. At least somebody will be benefiting. But it will have major spillover effects to add to the list of risks mentioned by Avi. That will be at trade risk in some sectors that they can't take care of themselves if they are called steel, aluminum, cement, but they are part of a supply chain that could be impacting society and labor in different ways. And IRA, I was with some investors, encouraging them from Connecticut in particular, working there, to invest in green hydrogen, very promising in Africa. 7 countries have plans for that. But now they told me it's different from our discussion in Sharm el-Sheikh. After the IRA implementation, they need to think twice if they are going to be investing in the global south, given the generosity of these kind of funding. So in order to do better going forward, we need to go back to these rules of engagement on the finance, on the incentives, and on technology and R&D. Otherwise, some of these bridges will not be complete enough.
Thank you very much. That's, I think rules of engagement is the key word there. And I thought what you said was very interesting. I'm going to turn to the audience in a minute, because I'm sure people have had time to think about very good question to ask you. But I think the 2 levels that you discussed with us, projects and project preparation, but at the same time, this rule of engagement, this constant dialogue between the bottom-up project preparation and the rules of engagement, particularly in the global north, on how funds can be deployed and how the incentives can be built towards the global south, to me, seems to be very, very, very important. Do you want to add something as you pick up?
One of the challenges we've had is this chicken and egg situation, that one of the riskiest part of the investment cycle is the project preparation. And you'll only do it if you think there's finance going to be there. And because finance has not been there, people have not been investing in project preparation enough. But I think there's also a role, because we need to accelerate all these projects and get a lot more projects, for the public sector to help in that initial project preparation process, especially before it's clear that the finance is there.
Yeah. How
Fully agree with that, I have to say. I mean, we've been doing a lot of work on seeing how public financial institutions, MDBs, but not only, I think the broader ecosystem of public development banks can really help mobilize more capital. And I think one of the buckets that we have looked at is really project preparation. How can you help address, how can you build the pipeline of projects? How can you help address some of this, business development risks that we see, particularly in emerging economies? And I think there's, again, I want to make sure that everyone understands there's a lot of existing initiatives. We can easily build on those. We can easily enhance them. And really, at the same time, I think, massively invest in the public development bank ecosystem to strengthen their capacity to do project development and project preparation, because I think that is something that really will help, the chicken and egg problem, like ensure that there is the pipeline and then ensure that there is kind of the right kind of risk sharing between different types of actors in the space here.
Yep. No, I fully agree. And if you ever have any doubts, I strongly advise. I was lucky enough to visit Bam Bam in Egypt. It's an incredible project. The level of technology deployed and the way in which it's been developed, and quickly it's been developed. It's been a matter of 5 or 6 years to build one of the largest solar plants in the world. It's really astonishing. But let me turn to the audience and see if anybody has any question or anything to add. I see one hand back there and then one in the very back. So yes, please, ma'am. If you could introduce yourself and keep your question brief, it would be very, very...
Thank you. Karen Wilson. I actually just came from the OECD Green Finance and Investment Forum. And actually, they were admitting that there's been a lot of talk about financing climate, but not enough action. And of course, we're hearing that the flows are increasing, but as you admitted, Barbara, 75% is going to developed countries. So I really appreciated what Avi said. It was really refreshing to hear. What you said is really fundamental. How do we get more money flowing to developing countries and stop talking about it, but do it. We really have to make big changes, and I would love to hear some more ideas from the panel in that respect. Thank you.
Thank you very much. So I have a person in the very back, and then somebody here in the front. Was there somebody in the very back that had a question? Yeah.
I love mine of the One Goal Initiative for Governance. We have met before last year, and I've given you my card, you remember, yeah. My question is, would one of you on the podium or somebody in the room champion the following thing? There's something I call globalization, which is the rise of cluster risk at this time. There's a lot of risk that's getting clustered in the current processes. And one potential one is where negotiations for international agreements gain in scope in multilateral platforms. Thereby, more chips are on the table. Thereby, there might be a group movement of chips to one side. So therefore, I think before such negotiations take place, we need to have rules on which we must base ourselves in order to avoid an unbalanced situation.
That's great. Thank you. Thank you very much. And I think there's a lady up front that had a question. Yes, sorry, I'll make you run with the microphone all the way to the front. Thank you. And then we'll turn to our panelists.
Hello, my name is Alicia Valdez. I am the President and CEO of Global Eco Army, Navy, Air Force, and Space Force. And we're like a vehicle, like building bridges. We're placing small, large, and Fortune 500 companies together with the average communities or any country worldwide that would like to give back to the community or their country or, you know, in any scale, pretty much. There is no such organization right now in the world that I know of, so that's something new that we bring to the table. And I've been also in the solar industry before. I was the president and CEO of Bright Solar Systems. And I was well acquainted with how subsidies helped us expedite the project sooner than later with residential homeowners all the way up to businesses. And it really helped, but the ROI was still far. So that's why I opened the nonprofit called Global Eco Army. And one of the ways that we bridge that gap of global warming and also the financing, it's getting funds from Fortune 500 companies. They always get a tax write-off, and we got some funds from, for example, State Farm, which is the largest insurance company in the United States, and Starbucks has been one of our sponsors too. So based on however they want us to distribute those funds, we can help either, you know, kids in Burundi, Africa, or Uganda, or even Egypt. We had a cleanup in Egypt recently, so I wanted
What's
to touch
your question?
base. Yeah, well, the question is, like, how do you think we can work with all of you based on, you know, my background and what we had brought to the table, which is planting trees in over 4 countries so far in 3 years and doing cleanups. So
thank you very much.
We can work together.
Thank you very much for your question. I'll take these 3 questions and then I'll go back to the audience. Okay, why don't we start, Mahmoud? What did you want to
Right, on the specific question that I think it was repeated in different ways, how can we do business better at scale in developing economies and emerging markets? I think there is a missing angle of the ultimate connector between the supply of assets and the demand coming from the pipeline of bankable projects. And Mark Carney, in a nice piece a couple of years ago, put that in a list of prerequisites. And I was teasing him, coming from developing economy, if we are going to be answering your 5, 6 requirements, will be an OECD country providing donations and support. But let's take it one step at a time. Of course, he's expecting governance, rule of law, deep capital markets and local currency, and pipeline of bankable investment projects. So we started with this one. But with an assumption that we can tailor solutions, as we did in the case of Ben, that we are not going to be making the perfect enemy of the good. Let's move on it gradually. And one area that I think we discussed when the His Excellency, the Ambassador of Egypt, invited us the other day, that there is a bigger role for investors, not just to say we have the funds, but as it happened when I was a Minister of Investment, I'm still proud that my country from 2004 to 2010 on average had attraction of net FDI that is the highest in the emerging world from different sources of capital and acquisition and in greenfield. Fixing the business environment was one, looking after big transactions another, dealing with the problems related to the domestic investors, because before I go and ask an investor based in Geneva, he has to be comfortable that his counterparts at home in the host country of these investments are good. But there is a role here for the multilateral development banks, because they are going to be the ultimate connectors between the supply and demand. In areas of de-risking mentioned different ways, they can leverage and de-risk the private sector. When it comes to the financial regulations and regulations of market, they can provide capacity development, but I assume that they need to do a better job in articulating the priorities based on the country's needs, not just to provide capacity development in what they see good. Here, the MDBs need to be with adequate capital, arguments, and there are many shareholders here, big shareholders of these institutions, arguing that these institutions can do better by just being more efficient, and squeezing the lemon is not enough. The capital for these MDBs today is a fraction of their firepower if you compare that to the 1990s. So they need to be adequately capitalized, getting adequate resources for them to be bridges of not just finance, but finance, knowledge, and capacity development.
That's great.
This is perfectly well, and we had not discussed that one before. But again, we've been looking a lot on what MDBs can do better. I think we are in a year of real potential for change. I think with the leadership change at the World Bank Group, but also with voices like Aves in the Bridgetown Initiative, I think there is a real opportunity to think about the reforms of the international financial architectures, MDBs obviously being at the core of that one. So fully embrace it. I think we need more, so we need more of their money, so we need to focus on the quantity, but I do think at the same time, there is a lot we can do also focusing on the quality, so really thinking about how can you use the existing capital that these multilateral development banks have more effectively. So we've been working on, again, some, and I'm going to mention 3 concrete opportunities, but we've been focusing really top-down at the systems level, on the operating model of these banks, what can be done more, and I think a lot that we've heard today could really kind of help them actually focus on changes. The first one is around having them really focus more on country and sector platforms. There have been a lot of developments over the last years on specific just energy transition platforms, but really focusing on the needs on the country level. How can you integrate the domestic financial ecosystem, the domestic financial players more? Because again, I think this is ultimately how you make sure that what flows into the country is really meeting the needs as well. The second is around risk-sharing instruments, and I think, again, we've heard a lot about that. I think we have identified a number of concrete risks and concrete solutions to those risks that could help really use, again, the scarce public capital better. For example, by having guarantees, more purposeful guarantees, better guarantees to address credit risk, looking at foreign exchange risk, and I'm sure Avi is going to say something about that, focusing more on the MDB's capacity for local currency lending and like using blending to increase affordability. But then also the final point that I made before around project preparation, how can you really increase their work on that point. And then the final one is, how can you actually align some of their incentives internally, and at the moment there's just the wrong internal incentives at multilateral development banks. There's no specific KPIs for mobilization, no specific KPIs for impact. So I think there's a lot that could be done by really changing their internal operating models and really standardizing some of these KPIs and like some of the asset classes and the underwriting principles that they have to really mobilize more capital. And maybe just a final plug for, I think there's a lot of thinking on concrete solutions out there, and I think that comes to a few of the questions here on where we can work together in some kind of incubators and accelerators where we bring together different actors across the financial ecosystem that really think more innovatively about solutions and how you can replicate what you have done in one country in other regions, and in this way really get to scale. And I'll stop here.
Three quick points. Firstly, we've identified through the session that the private sector has an important role to play, both domestic private sector and the international private sector. But there are many things the private sector cannot do. A large amount of the resilience and adaptation agenda cannot be done by the private sector. The revenues aren't there. There's some other reasons too. And so the multilateral development banks have to play a much bigger role. They've become irrelevant. They've become irrelevant in their size. They need to be 3 times bigger. And that way that they can channel investments to things that need to be done that the private sector can't do. In the way they channel investments, they can start changing the international pricing of things that we value. They need to be 3 times bigger. And as Mahmoud said, we could probably get they could probably double their size by using their balance sheets and their capital much smarter, but they need to do even more than that with some more capital to get them to be 3 times bigger. Second quick point, the world is full of more and more shocks. We're in a more shock a more crisis, a polycrisis, it has been called. We need a more shock-absorbing financial sector. At the moment, we have a brittle, fragile financial sector that runs from risk rather than absorbs risk. And that's why we've been pushing something like pause clauses in all international financial instruments. They're not insurance, they're net present value neutral. When a disaster happens, there's a 2-year break, and the interest and principal is paid back later with interest, so no one is worse off, but it gives critical breathing space to developing countries. It would release, if every developing country had them in all of their instruments, $1 trillion of liquidity in a global crisis. There's no other instrument that comes anywhere close. And the final point is, one of the unique things that Patrick has done is brought together this event with the UN negotiation going on upstairs on something called 2.1c and Article 9. And this is about development finance. And one of the challenges we have in developing countries versus developed is this negotiation going on. Because the critical problem we need to solve is there not enough flows. But what our developed country partners are saying is, oh, they want to make these flows more conditional. They want to say all of these flows must be consistent with their view of Paris alignment, with net zero. And that's good things. But all of our flows, one of the challenges is that some development things, some things we need to do for society, for the environment, and for development, doesn't appear consistent. And some of the things we need in the transition, this is one of the points that I think Mattia and others made recently. In the way that we're trying to get very conditional on financing flows, we may be not providing finance for transition, which is critical in the process. So the problem we're trying to solve, there's not enough flows. Let's not make that harder. Let's make that easier.
Thank you, Avi. What an agenda for work. I hope we have started answering Uber's question, from what a Minister of the Investment can do to increase investment in their country, to what MDBs should do, to what regulators can do to increase flows to the Global South. I think the agenda for work is laid out. Some of the concrete action have been laid out. So let's get to work. Thank you very much.